January 2021. A hedge fund manager sits alone in a Manhattan office at 3 a.m., staring at a screen full of red numbers. $6 billion gone in 2 weeks. And the people who took it from him, they weren't on Wall Street. They were on their couches. This is the story of Melvin Capital, a hedge fund so confident, so dominant, it bet the house against a dying video game store. And it's a story of an army of amateur traders who found the fund's weak spot and pulled the trigger. By the time it was over, a 42-year-old firm run by one of the sharpest stock pickers on the street would be wiped off the map. Billions in losses, a congressional hearing, and a new kind of trader the entire financial world would never be able to ignore again. Meet Gabe Plotkin. A protege of legendary trader Steve Cohen, Plotkin launched Melvin Capital in 2014 with just under $1 billion. Within 6 years, he was managing over $12 billion, one of the most respected stock pickers in the hedge fund world. Melvin's specialty, short selling, betting that a company's stock would fall and profiting when it did. It's one of the oldest, riskiest plays in finance. Borrow the stock, sell it, buy it back cheaper later, pocket the difference. Simple until it isn't. And Melvin's biggest short, GameStop. Ticker GME, a struggling chain of mall video game stores bleeding customers to digital downloads and Amazon. On paper, it looked like a dead company walking, the perfect short. So Melvin, along with other big funds, piled in. They shorted so much GameStop stock that at one point, the number of shares sold short exceeded 100% of all shares that actually existed. Wall Street had never seen anything quite like it. It was the ultimate Wall Street power move. Billions of dollars betting against a struggling underdog, but nobody at Melvin Capital was watching a scrappy corner of the internet called Wall Street Bets. And that was about to become the most expensive mistake in hedge fund history. To understand why Wall Street was so sure GameStop was doomed, you have to understand what GameStop actually was. Founded in 1984, it became the place millions of kids begged their parents to visit. Rows of game cases, used game trade-ins, the smell of new plastic. But by 2019, that world was collapsing. Digital downloads meant nobody needed to drive to a store to buy a game anymore. Amazon undercut its prices. Malls themselves were emptying out. Store after store, GameStop was closing its doors. Its stock, once worth over $60 a share, had crumbled below $4. Wall Street analysts called it a value trap. Hedge funds smelled blood. To them, this wasn't just a bad business. It was a business already circling the drain, and shorting it felt like free money. But a few contrarians saw something else. Ryan Cohen, the billionaire founder of pet supply giant Chewy, started buying up GameStop shares in 2020. His pitch: turn the dusty mall chain into an e-commerce powerhouse. Wall Street rolled its eyes. Retail investors leaned in closer. Then came a discovery that would light the fuse. Because so many hedge funds had shorted GameStop into oblivion, the stock was sitting on a mountain of short interest. Over 140% of its available shares. That number wasn't just a red flag. To a sharp-eyed trader, it was a target painted on Melvin Capital's back. Because when more shares are shorted than exist, there's only one way this can go if the price rises. Those shorts must buy the stock back, no matter the cost, to close their position. It's called a short squeeze, and it was about to be triggered by the last people Wall Street ever expected. Enter Keith Gill. By day, a mild-mannered financial educator at an insurance company in Massachusetts. By night, under the username Roaring Kitty on YouTube and Deep Fucking Value on Reddit, he was quietly building one of the most consequential trades in market history. In 2019, Gill had put around $53,000 into GameStop call options, a bet almost nobody understood or believed in. He posted his brokerage screenshots to a chaotic, meme-drenched Reddit forum called Wall Street Bets, home to a million self-described degenerates gambling their savings on options. This story later became so famous, it was turned into a Hollywood film, 2023's Dumb Money. with Keith Gill played by Paul Dano, cat headband and all. But in 2020, he was just one guy, posting spreadsheets nobody asked for, insisting the math on GameStop simply didn't add up. His posts, or due diligence in Wall Street Bets slang, spread. Slowly at first, then explosively. Other users began piling in. Nurses, students, delivery drivers, people who'd never owned a stock in their life. The pitch was simple and electric. The hedge funds are overexposed, and we can make them pay. This wasn't just about money anymore. For a generation that had watched the 2008 financial crisis wreck their parents' finances while the banks got bailed out, GameStop became something bigger. A chance to turn the tables on Wall Street itself, using Wall Street's own rules. By early January 2021, GameStop's stock, once under $4, had climbed past $20, then $40. Wall Street Bets ballooned from a few 100,000 members to millions, refreshing their apps by the minute, posting rocket ship emojis like a battle cry, to the moon. And on the other side of the trade, Melvin Capital and its fellow short sellers were about to discover something terrifying. This wasn't a handful of gamblers. It was a coordinated wave of buying pressure. Millions of small trades stacking into something no algorithm had modeled for. To understand how retail traders broke a hedge fund, you need to understand two words: short squeeze. When a stock's price rises, anyone who bet against it, who shorted it, starts losing money. And the higher it climbs, the more desperate they become to escape. The only way out of a short position is to buy the stock back. But when the short sellers all rush to buy at once, that buying itself drives the price even higher, forcing more shorts to panic buy, which drives the price higher still. It's a feedback loop with no ceiling. But Wall Street Bets had a second weapon, and it was even more powerful: the gamma squeeze. Instead of just buying shares, thousands of retail traders bought call options, contracts betting the stock would rise for a fraction of the cost of owning shares outright. Here's the trick: when someone sells a call option, they're obligated to deliver shares if it's exercised. To stay protected, the market maker on the other side of that trade has to buy real GameStop shares immediately. The more calls bought, the more shares they're forced to buy. That forced buying pushed the price up further, which made even more options attractive, which triggered even more forced buying. Retail traders had accidentally discovered a way to make the market itself do the squeezing for them, automatically, relentlessly, mechanically. On January 27, 2021, GameStop stock hit an intraday high of $483 a share. A company worth barely $200 million weeks earlier was suddenly valued at over $20 billion. It had risen more than 1,700% in under a month. For every dollar the stock climbed, Melvin Capital's short position bled deeper. And by the last week of January, the fund built to outsmart the market was staring down a hole it could not dig itself out of. Behind closed doors at Melvin Capital, the mood was closer to panic. Every point GameStop climbed cost the fund tens of millions of dollars. Brokers were issuing margin calls, demanding more cash as collateral, or forcing the fund to close its position at a catastrophic loss. On January 25, 2021, Melvin Capital made a desperate move. It closed out its GameStop short position entirely, buying back shares at whatever price it could get, crystallizing the loss instead of risking it grow larger. It didn't matter. The damage was already done. 2 days later, Melvin's fellow billionaires stepped in. Steve Cohen's Point72 and Ken Griffin's Citadel injected a combined $2.75 billion into Melvin Capital just to keep it alive. One of the largest emergency hedge fund bailouts in Wall Street history, arranged in a matter of days. By month's end, Melvin Capital had lost 53% of its value, roughly $6.8 billion, in under 4 weeks. This is the moment portrayed in Dumb Money, the 2023 film dramatizing the saga, where Gabe Plotkin, played by Seth Rogen, watches his fund's fortune evaporate in real time. Then came the moment that turned outrage into fury. On January 28th, Robinhood, the trading app millions of retail investors used, abruptly restricted buying of GameStop and other meme stocks. Retail traders could sell, but not buy. To many, it looked like the game had been rigged in real time. Robinhood said it was a clearinghouse liquidity requirement, not a favor to hedge funds. Few believed it in the moment. Class action lawsuits followed. So did a congressional hearing where Robinhood's CEO, Melvin's Gabe Plotkin, and Keith Gill himself all testified before Congress. Melvin Capital survived the immediate bloodbath, but the fund that once managed over $12 billion and the reputation it took Gabe Plotkin a career to build would never fully recover from those 4 weeks in January. GameStop's stock eventually came back down to earth, settling well below its January peak, but it never returned to the $4 stock Melvin Capital had bet on. Retail investors who held on, the ones who held the line, had permanently changed the company's fate and its cap table. Melvin Capital limped on for another year, still managing billions, still trying to rebuild trust. But the fund never escaped the shadow of January 2021. Investors pulled their money. Performance never recovered. In May 2022, Gabe Plotkin announced Melvin Capital was shutting down for good. A firm that once managed over $12 billion, run by a trader once considered one of the best of his generation, closed its doors entirely. A stunning fall for a fund that just 18 months earlier seemed untouchable. Wall Street took notice. So did every hedge fund manager watching. The story became a cultural phenomenon almost instantly. Books, documentaries, and in 2023, the feature film Dumb Money, starring Paul Dano as Keith Gill and Seth Rogen as Gabe Plotkin, brought the saga to movie screens worldwide, cementing it as one of the defining financial stories of a generation. But beyond the headlines and the movie deal, GameStop exposed something real: the fragility of concentrated short positions, the power of coordinated retail capital, and how thin the line had become between the market and a live stream chat room full of strangers with brokerage accounts. Regulators tightened scrutiny on payment for order flow and short disclosure rules. Brokerages rebuilt their risk systems, and an entire generation of new investors learned, in the most dramatic way possible, that markets aren't just driven by spreadsheets, they're driven by belief and by crowds willing to act on it together. Melvin Capital is gone. GameStop still trades, and somewhere, in a home office with 2 monitors and a cat headband, the story that started it all is still being told, one meme, one Reddit post, one retail trader at a time.